Hello there. This actually came from one of your colleagues in this course who said it'd be nice to have some real world examples of how to calculate ratios. So, ratios are vertical analysis of companies. And here on the spreadsheet, we have two balance sheets, one for the beginning of the year, say end of 2015, one for the end of the year 2016. And the way that financial statements are put together is that you bookend balance sheets. So you have a balance sheet at the beginning of the year, and then you have the income statement, and then reconcile that in the cash flow statement. And then you have a balance sheet for the end of the year. So what we will do here is calculate a couple of ratios. I've done them down here, and I'll show you how to do them. And they are balance sheet based ratios. So they're based on these numbers here. So when you're looking at companies and analyzing them, there's two ways that you do it. One is horizontally, right, across time. So here we go from 2015 to 2016, and you could look at things and see if there's more cash, yes, their cash is growing. You could look to see if you had more income statements, if revenues or sales are growing, if expenses were being reduced. So that's horizontal analysis. Ratio analysis is a vertical analysis where we're actually looking and stacking one number above the other from either the income statement or the balance sheet, or maybe a balance sheet number and an income statement number mixed. So that's how ratios work. And vertical analysis is a proportional analysis that's performed on financial statements. And there's different line items that may be of interest, and the way that they'll be represented is as percentages or as of numbers. So we're going to look at a couple of financial ratios here. We're going to start with, there's basically, financial ratios are powerful tools that are used to assess a company's upside, downside, and its risk. So there are four main categories of ratios: liquidity ratios, profitability ratios, activity ratios, and leverage ratios. And leverage ratios are basically how much debt to equity a company is carrying. Activity ratios would be turnover ratios, like how quickly are we turning over accounts receivable or inventory. So what ratios do is that they allow you to compare different size companies to each other and look at performance metrics. So what they allow us to do is to normalize the numbers so we can compare apples to apples. If we had one big company and one small company, it'd be very difficult to compare them unless you did it as a ratio. When you take two numbers and then it becomes a percentage, then you can look at those, compare those percentages, and it takes out the scale, the size of the companies. So we're going to start out by looking at liquidity ratios. And we're going to look at liquidity and solvency ratios right here. And solvency and liquidity, they both refer to a company's financial health and viability. Solvency refers to a company's capacity to meet its long-term obligations, and liquidity refers to an enterprise's ability to meet its short-term obligations, meaning can it pay the bills that are coming due in the near future. So a solvent company is one that owns more than it owes. So you can think of a balance sheet like a house, right? Where the asset is the house, that's the appraised value, and then the liabilities are the mortgage, the debt, and then what's left over is homeowners' equity, the equity, right? So you can think of a balance sheet for a company kind of in those terms like you would think of as a house. So in a house, you want to owe less than the amount of the assets so that there's some equity, right? Same thing with a company. So what we're going to look at first are the liquidity ratios. And they are used to determine whether a company has enough current assets to pay off its current obligations, its current liabilities. So there are two liquidity ratios that are used a lot. You may have heard these terms before. I'm also this spreadsheet will be a downloadable document for you in the course here, so you can go and check it out. And I've put notes next to each one of these too, so that you can see what a little description of each one when we go in and look at those numbers. So the current ratio is a very popular liquidity ratio. And the current ratio basically it's just like it says, it takes the current assets and compares them to the current liabilities. So in this case, in 2015, we have 1275 as our current assets. That's these assets added together, right? And current assets, basically, we start with which is the most liquid, and with all of the way we rank these. And so cash is always the most liquid. Accounts receivable is next because we're promised that that money's going to come in. Our inventory is next, and then our prepaid expenses. The inventory is sort of a questionable one to turn into cash, though. Once we build something and have it in storage, sometimes it's hard to turn it all into cash unless you steeply discount it, right? So that one is a little bit questionable. But in the current ratio, we take all those, add them up, and then we compare them to the current liabilities. So here we've got, that's just the sum of those numbers, right? And then here it's the sum of these numbers. And so this ratio is basically just taking this number here, and dividing it by, this number is the current assets, and dividing it by the current liabilities. So that's the formula there. I'm going and just grabbing G17, right, this number here, and then dividing it by G27. And so that comes out to be almost 5, right, 4.8. And you can see that that's about right. Like this is, say, round this to 250 and round this to 1250, and you can see that this number is 5 times as big as that. So we can see that this number is correct in what it is. And that way you can quickly look at things too without having to actually do the calculation and say, is this a pretty big multiple, a significant multiple of those liabilities? If this number was 1,200 and we only had 250 in the bank, we'd be in trouble, right? So that's how you calculate the quick ratio. And here it is again for the next year, right? For 2016, we're going to compare this number and divide it by this number. And if I double click on this, you can see that's the two numbers, and that's the formula that we have there. So that's the current ratio. Now the quick ratio, and here's the note. So you can see these notes. I'll give you this so you'll be able to look at all this. You'll be able to play with it. You can go over here and calculate any numbers you want and see how these are calculated to download it. So the quick ratio is similar, very similar to the current ratio, but it excludes inventory. As I said earlier, inventory is a little bit questionable as a liquid asset. It's in our current assets, but if we had to quickly convert all our inventory to cash in order to pay a bill here, we'd probably have to sell these things at a fire sale. We probably wouldn't get the full 420, for the inventory. We might get half that or something. So what the quick ratio does is say, okay, let's exclude inventory from the current assets and then do that calculation. So you can see in these cases, the quick ratio is a little bit less. Numerically, this is 4.8, and the current ratio is 4.8, and the quick ratio is 3.2. So what we're doing here, and you can see by the formula, is we're taking this sum, G17, and we're subtracting G15, the inventory. So that's just these numbers here. You double click and it goes, you can see it expand the formula, and then I'll just hit return. So you can see that that's how the quick ratio is formed, and the same thing for these numbers here. It's just excluding the inventory and seeing if you still have enough money to make your bills there, pay it. So then we go, and now we can look at the solvency ratio. And the solvency ratio is basically used to examine a company's ability to meet its long-term obligations. Can it stay in the business for a long time? Sometimes a company can certainly be able to pay its bills for the next quarter or two, but in the long term, it's going to go bankrupt. And so that's a concern, especially for people who lend to a company. If you're buying corporate bonds, if you're a banker, if you're doing credit analysis of a company, you're going to want to know the risk of, are you going to get paid back the money that you've lent to that company? So you want to see that if the company has a good, strong solvency ratio. And the solvency ratio, as you can see in this note, 20% is considered a financially healthy ratio. So this one just meets that criteria, 21%, right? And the way that the solvency ratio is calculated is that it's looking at it takes out from it's looking at net income, and it's comparing that to the short-term and the long-term liabilities. So here's the current liabilities, and there, in this case, here's the long-term liabilities. In this case, it's bonds, right? And this number here is the total liabilities. It's these two added together. So that is the bottom of the ratio, the numerator, and then up here we have what we're looking for is how much net income the company's making, but also adding back and forth all the non-cash stuff. So what we're really going to look at is the cash flows from operations, where we take the net income and add back or subtract the changes in accounts receivable or depreciation, things that are non-cash. So you can see really how much cash the company generated from operations in this period, right, in this year, and we're going to divide that by the total liabilities, this number here. So it's basically this number divided by that number. And that's what this is telling us right here. That's what this is. See? It's this number divided by that number. And then that comes out to be a percentage. In this case, it's 21%, and that's a good deal. So those are the three ratios, balance sheet ratios to look at liquidity, liquidity and solvency. So I'll come back and do some more of these for the other types of ratios too. But this gives you an idea of how they're calculated. And again, this spreadsheet will be included as a download for you, so you can download it and play with it as much as you want and check out these the notes here and these different equations and all how these how all these financial statements are connected together, because it shows these things actually have the formulas in them for where these numbers are being pulled from and all that. So it'll give you a good handle on how the financial statements are interconnected and how they flow, and also how to calculate these ratios. So I hope that was clear, and thanks very much for listening, and enjoy the rest of the course.